All right, boys and girls. Today I want to talk about simulation analysis and scenario analysis. Okay, so what is this? What's it used for? Why is it important? Why do we do this? This first came up on my radar back in business school, like literally probably 2 decades ago. I'm gonna date myself a little bit here. Finished my MBA in finance at Johns Hopkins back in 2003. So 21 years ago, going on 22 pretty soon. So this came up in my classes. I think it's fascinating. I did this work in Excel a long time ago, and I want to translate everything into Python right here, right now. Okay, so simulation analysis, what is this? It's based on random sampling and uncertainty, and it's used for modeling complex systems and unpredictable factors. Certainly stock prices are driven by stochastic probabilities, right? Very random, somewhat based in reality. I have several videos about how to value a stock, how to manage the risk of a portfolio of stocks, how to do portfolio optimization. You can check out all those videos. It's very interesting, but it's somewhat arbitrary and a little bit random too. If everybody could predict the future price of a stock, everyone would be mega billionaires, right? Like Bill Gates and Jeff Bezos and Elon Musk and all these guys, right? Like, but we can't do that because it's too random. But we can try. We can try to do some analysis and get pretty close, but we can't get exactly right. So what's scenario analysis? This is more predefined assumptions used to evaluate more economic types of scenarios, predict possible future outcomes based on varying conditions. Again, somewhat related to finance, risk management, just like simulation analysis. But scenario analysis provides like a little bit more discrete types of outcomes, where simulation analysis is more indiscrete or based more on float numbers, right? Decimal places. Scenario analysis is more based on integer types of outcomes, right? So discrete versus continuous. So simulation would be more continuous and scenario would be more discrete. So simulation analysis basically helps us model simulating or trying different types of possible outcomes by generating random variables, right? We use Monte Carlo analysis for this. Monte Carlo is a famous casino, right? Where you go to the casino and you can win money, you can lose money, anything can happen, right? It's mostly random. You really don't control the outcome. You can play roulette, you can play blackjack. You kind of feel like you control the outcome, but you really don't, right? It's really based on random chance and probability, right? So you can imagine you're analyzing the potential future stock price of any kind of equity that's traded on any exchange, right? So we can do that here. I'll post all the code. We don't have to understand all the details here. I'll post it when I post the video and you'll have access to everything. You can run this in your own Jupyter environment. But I will introduce you to a couple of key factors here. So you have the initial price of the equity, the mean return, volatility, time horizon. This is 1 year out. Number of simulations, we're going to do 1,000, and number of steps. This is trading days in the year. Okay, you subtract out all the weekends, so Saturdays and Sundays are gone. You subtract out major holidays, Thanksgiving, Christmas, New Year's, 4th of July. What else? I think President's Day, the stock exchange is closed. There's about 11 days where the stock exchange is closed. So we have 365 minus the weekends, minus the holidays, you get to 252. So let me hit Control-Enter to run the cell here. We'll see what the output looks like. And again, I'm going to copy and paste all this code and share it with you when I post the video, just like I do with all of these things, right? It's always the same. See what kind of thing we get here. Okay, that's it. So we have all the forecasted stochastic probabilities starting with a stock price of $100 at day 0. Okay, on the x-axis, x goes horizontal, y goes vertical. We start at $100, day 0. It goes up to almost 200, so almost doubles in price in 1 year, and it almost goes to 60, so it goes down 40% approximately, and those are the stochastic probabilities. So let me rerun the code here and get one more view and look at a couple of statistical types of patterns too. We want the daily return, new price, prices, and the price path. Okay, and we can see here the stock price on average is going to be about $145.67. So that's the simulation analysis. We start with a stock that's $100, right? And this is arbitrary. You can put any stock price in here. You can put Amazon, Microsoft, Starbucks, AT&T, Verizon, any publicly traded company. You'd have to calculate the mean return. You can actually get this stuff online too. You can import it. I have several videos about how to import data from the web, doing screen scraping. So you can put in a stock ticker, get the price today, get the mean return and the volatility, and calculate these things and make it like a little bit more realistic. This is a little bit more academic and a little bit more theoretical. Most of my videos actually are very realistic and practical. This one I kind of deviated a little bit, kind of got a little bit lazy. Sorry guys, but it took a little while to put together the code. But you can easily screen scrape this data. If you see my other videos, you'll see how to do that, and you can put in like real data right there. Maybe someday, if I have time, I'll come back and do that. But anyways, I just wanted to demonstrate the principles of simulation analysis, and I think we illustrated the point. Okay, let's look at one more example down here using the same data. We can look at the different rankings of stock from $54 up to $65, and then we have some statistical features of this simulation analysis fallout. We have the mean, median, 10th percentile up to the 75th and 90th too. So this would be almost the best case scenario, and the average would be here, and this would probably be the worst case scenario. So if you buy the stock at $100, it could go down to 81 in 1 year. It could go up to $134 in 1 year. Okay, so this is just simulation analysis of one stock, kind of theoretical and hypothetical too. That's it. I think we illustrated the point. I think we proved our case here. So now let's move on to scenario analysis. This is a little bit different. So with simulation analysis, it's more continuous. Scenario analysis is a little bit more discrete. So you have differences in predefined scenarios, and it typically focuses more on assumptions of variables, changing of values of these variables over time, mostly focused on economics and finance, kind of like simulation analysis. Scenario analysis is somewhat similar, but it doesn't rely on randomness. It actually depends on different assumptions that you define in advance, right? So simulation analysis is great for pricing or predicting the future outcome of stock prices. Scenario analysis is more based on economics, maybe manufacturing, maybe some type of government enterprise, some type of business transactions where the business isn't based on randomness, right? Hopefully your business isn't random. That would be kind of crazy if it was, but hopefully it's not. But it's more based on assumptions that you predefine, and you try to look into the future and predict what's going to happen, right? But it's not random. It's more based on specific scenarios and probabilities, right? So you can imagine that you're analyzing a business profitability by quarter, by year, right? Best case scenario is going to be ABC, XYZ, whatever. Base case scenario is in the middle, and then the worst case scenario is the worst, right? So best is the best, and the worst is the worst, and the base is in the middle. Okay, so let me run this, not rerun. Sorry. Let me run this code, and we see the best case and the base case, that's the average, and then the worst case, okay? So we have this output right here: sales, cost, profit, taxes, and then net profit. So here is the best case. The sales are the max. The base case, this is the average sales that we can expect. And the worst case, that is represented right here, right? So the costs are going up a little bit, but the sales are a little bit higher. The profit's higher, taxes are higher, and net profit is higher, right? Here in the base case, this would be the average. Profit is slightly lower, but still pretty close to the best case. The worst case is actually like almost half. This is dismal. This is not the outcome that you want. This is probably the outcome that you're going to get, and this is the best you can hope for. So let's look at this example again and rerun this analysis, but get more output, and we're going to graph and plot this too. So we're looking at initial price of $100, number of simulations 1,000, and number of steps 252 trading days in a year. So it's a little bit arbitrary. We're not looking at stocks at this point. This is more like the business profitability. But again, like how often is the business open? Probably as often as the stock market is open. So 252 days is basically 365 minus Saturdays and Sundays in the calendar. Every Saturday and Sunday you can subtract, and the major holidays, right? So all Christmas, Thanksgiving, New Year's, 4th of July, President's Day, Valentine's Day. I think people are still going to work. Maybe not if you work at a special company, but you take 365, subtract all of these business days and holidays, and this is what you're going to get. So let me go ahead and run that, and we'll look at a couple different statistical outputs here. Here's the mean price, median. Mean is the average, median is the middle, percentile is 10. Okay, so we're doing like percentile. We're using the NumPy percentile function here. 10, 25, 75, 90. It should be a little bit intuitive if you look closely at that, right? And then we're going to push everything into a data frame. Most of my videos, I create a data frame for everything because it's just easier for plotting and charting. If you try to do charts and plots on non-structured data, that's going to be very hard to do. And when you structure it, you put it into a data frame and everything is in rows and columns. A little bit like Excel or like what you would see in a table in a database. Once everything is structured in a row and a column, it's very easy to plot the results. If it's not structured, it's maybe scattered between, the output could be actually scattered between multiple text files, multiple CSV files, different columns and different rows. That's kind of messy when you're trying to plot your results and get everything neat and orderly. You want it structured, and the pandas data frame is going to do that for you. So it's PD is the abbreviation for pandas. We have that over here. Import pandas as PD, and NumPy is doing the numerical analysis for us. So NP percentile, NumPy is the statistical or the mathematical library that we rely on most of the time, and pandas is the way that we structure the data. So rows, columns, you can do imports, exports, you can do merges, joins, concatenations, lots of different things, right? So if you want to get your data structured and organized and just basically straightened out, you use pandas for that, okay? So I think we have the results right here, and here's the different scenarios. So scenario 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, up to 20. We have the mean returns, the volatility, time horizon, mean, median, 10th, 75th, up to 90th percentile, right? That's what I just showed you over here, all right? Everything is organized and structured, straightened out in a data frame, but originally comes from here. So it goes from NumPy into pandas. Very nice. Let me hit Control Enter and refresh this. See what your results look like. Okay, so we have mean final price across all scenarios. Okay, so remember this is scenario analysis. We moved on from simulation analysis. Simulation is more random. Scenario is more defined, more somewhat more like discrete, right? With simulation, it's more continuous. With scenario, it's more discrete. So we have these structured buckets right here, scenario 1 through scenario 20, and it could be anything in between. So we could expect that our business is going to make at least $100. This is scenario 1. This is like 105 maybe. Best case scenario might be like 100. I'm looking at scenario 18, 160, almost 158 maybe. So between 105 and 158, all these scenarios play out pretty nicely. Let me hit Control Enter to refresh this cell and see what we get here. Here's the distribution of prices. So scenario 1 has kind of the lowest price, I think, pretty much the lowest. Maybe scenario 2 is about the same or a little bit lower. So yeah, I think scenario 2 is a little bit lower, but you have scenario 1, that is almost the lowest price. I guess number 2 is the actual lowest. But then you see the distribution based on this box plot. So scenario 12 has the probability to be higher profit, right? But higher distribution too. So you look at the top and the bottom of this T, you have a T over here and an upside down T on the bottom on scenario 12. So you have the potential to have a higher income, but a bigger distribution of incomes too. That's what the box plot is showing us. So let me go down here and create a heat map. I'm just running these charts just so we can visually see how this data looks. So here we're looking at 10th, 25th mean, 75th, 90th percentile, and how everything shakes out. So scenario 1, the 10th percentile is actually the lowest. If you look over here on the right, we have red, yellow, and green. 50 is low, 250 is high, red is low, green is high. So the lowest income, scenario 1, matches up with this right here, right? Scenario 1 has lower income, scenario 1 has a lower income. Scenario 20 and scenario 12 have higher incomes. If we go down here, scenario 12 has a higher income, 284, and 20 is 289. So the best case scenario here is visually represented in this plot, $289. And the worst scenario over here is about 79. 79. That would be the income for this business. Control Enter. I think this is the last chart that I have here. Yeah, it's the same thing. So same number, 79.3, upper left-hand corner, kind of looks like Washington State. Here's Florida down in the southeast, 289. These are just red colors. These have red, yellow, green. Green is the highest, red is the lowest here. Dark red is the highest, and light pink is the lowest, right? So it's another type of heat map, just a different rendering of colors, right? So that's kind of it, guys. Simulation analysis is used in finance, insurance, supply chain management, economics, risk assessment, engineering, where there's some type of uncertainty or variability that we're trying to understand and assess and predict. All right, simulation analysis is great for that. That's Monte Carlo simulation. Scenario analysis is used more for strategic planning, business forecasting, policy analysis, project management. And we're looking at predefined scenarios to help us make better decisions, more intelligent decisions, more intellectually refined decisions based on the probability of distributions of outcomes for our business, right? And it could be a quarter out, it could be 6 months out, could be a year out, whatever you define, right? So that's pretty much it. Hopefully you learned something today. I learned something putting this together. I filled in a few knowledge gaps I had. I kind of understood this before. When I was putting together all the code, it really helped me to distill everything in my brain to get to this point right here. So hopefully you learned something. I certainly didn't. So that's it, guys. Thanks for your time today. Enjoy the rest of your day. Thanks. Bye.